Hey everyone, and welcome to today's show on Wealth Strategy Secrets. Today we are joined by Richard Coyne. Richard is a full-time real estate syndicator and investor. He formed his first company in 2016 to invest in real estate and then partnered with Bill Zahler to form Park Capital Partners. Park Capital helps busy professionals achieve passive income by gaining access to the private real estate market through shares of syndicated multifamily real estate investments. Richard completed postgraduate real estate analysis and investment coursework at MIT's School of Architecture and Planning and is a retired software executive with more than 30 years of experience. He held a PMP and leverages that discipline in apartment analysis, investing, and operations. And Richard is also the co-host of the Asheville Multifamily Investor Club, co-hosts the Road Less Traveled podcast, and serves in a variety of volunteer roles, including co-founding the Park Capital Partners Foundation. Richard, my friend, welcome to the show.
Well, thank you, Dave. It's an honor to be here. Really appreciate you having me.
Yeah, no, great to have you on. And we've had the experience to partner before, which has been fantastic. And I know some of our community is familiar with you. But for those of that are not, can you talk to us a little bit about your background? What was that moment in 2016 that you got into real estate and started making things happen?
Yeah, glad to. Again, appreciate you having me on. Glad to tell my story, and again, obviously, wish all your folks and listeners continued success in what they do. So, for me, it was a very much a story of being the busy professional. I talk about how we bring investment opportunities to the busy professional, and that's who I was. We had I have three kids. We've talked about this, Dave. You have triplets, I have twins, and so they have an older sister, so boy girl twins, they have an older sister. So our we made a decision when the kids were little that my wife was going to be a stay-at-home mom, to really spend time with the kids and help mold them. And part of the reason for that is because I was on the road all the time. I was a traveling consultant. My role changed over the years, but I was a traveling consultant where I was gone all the time. And we wanted to have obviously a stable parent influence with the kids, and again, that was the right decision for us. And then as the kids got a little bit older, we chose to send them to private school. That's a luxury that some can't afford. So we certainly recognize that we were very blessed in that respect to be able to send our kids to private school and then ultimately a college. But being the busy professional, what did that mean? That meant I was gone. Then I was heads down working my what off. And then when I was home on the weekends, that was family time. So, we chose to do things together. But again, we made the decision to do the right thing for our family and to send our kids to private school. And again, that meant it had to be paid for. It was certainly the right thing for our family. My older daughter started private school in sixth grade, graduated, then on to college. My twins, the first experience within the first 6 weeks of our older daughter going to private school was such a positive change in her in terms of just smaller classroom size, more individual attention from the teachers, that we decided to put the twins there. And they started in third grade and graduated all the way through. So again, a lot of private school bills there that took away from our being able to really put some of the money I should have put aside for retirement early on. It took away from our ability to, the sacrifices meant we didn't go on the big vacations and things like that. We didn't, have the mega house. We had a very nice, wonderful house. We made a home for 20 something years. And in Atlanta, it was a great house and a great neighborhood and great neighbors and all that good stuff. But, we deliberately chose not to go on to, perhaps the big house. And, in a way, I'm a genius, because then 08, 09 happened, and we're like, oh, okay, well, we're living within our means instead of stretched too far, but again, so when I guess it was probably in about 2015, when I really started kind of going, this was the the kids were college, and I'm like, I really got to do something for my wife and I for our retirement to really, propel forward what we were doing. And prior to that point, it was just simply just do the normal, put some money in the 401k and company matching, and then you've got choice A, B, or C mutual fund to pick from, and that's about it. I didn't really know anything about real estate, but again, the point is that around that time frame, I just had a light bulb go off saying, all right, look, it's time for me to focus on the forward for my wife and I for what we're going to be able to do down the road, and really put some acceleration on our wealth building, our ability to have the kind of future life we want to have. So we I looked around at a number of different things, and I decided, I'd always been interested in real estate. I'd always been interested in kind of the aspect of things. I knew about people who were doing real estate investing. Didn't really have the knowledge myself, but I chose to go down the path of really learning, really building my knowledge. And I'm a huge believer in education. Learn about what you're going into first, before you jump in the pool. You got to take action, but at the same point in time, understand what you're going into, learn the language. And so my wife and I purchased a single family house on a short sale. We're very happy that we were able to go into that investment, but literally 2 weeks after we had that house under contract, I ran the numbers, and I'm like, wait a second here, $100 passive income. Holy Moses, that's a lot of houses to replace my income. I realized that wasn't going to cut it. I had to go bigger, faster. And that's when I shifted my knowledge gaining into just, instead of learning just about doing real estate acquisition, or learning about apartments and learn how to acquire apartments. So we went down that path to really learn how to do that. And we've been able to do a lot of successful things for our investors. And again, we have kind of three goals for, when we acquire an apartment, and we're acquiring large apartments, 100 units and up. Our goals are: one, make our investors money; two, give them a return on their investment; and number three, improve the apartments that are there. When we leave them better than we found them, we improve the units along the way. So hope that gives a little background.
Yeah, that's great, Richard. Appreciate you sharing that story. And it sure does hit home for me because, we're definitely on zone defense, right? Having multiple kids. So all those listeners out there who are struggling raising one child right now, just be lucky you're not doing multiple at the same time.
Yeah.
But it was also, for me, that was also really the same, light bulb moment when I kept, going to the financial planner and him saying, well, it's about $1 million each to raise a kid. I now have 4 of them, right? And then there's this other thing called retirement, and you're going to just put all your money in the 401k, and then market's going to go up and down. You'll have this volatility to it, but you'll make 7% in the long haul. And I just could not figure out how you can move the needle, with that, right? And then every time you make more money, with a W-2 job, right? Half of it is getting taxed. So right. It's like you need to be earning double. So, that was really the, big transformational moment for me as well, to really get, serious about learning, how are the ultra wealthy really investing? And it's no mistake, right? Why so many ultra wealthy millionaires, billionaires have created their wealth through real estate. Mm-hmm.
There's a little nugget that I love from a James Rickards book. I can't remember the name of the book right now, that he talks about that. He talked about an event. He was in Italy where he was having a dinner at an ultra wealthy group of people, and one of them was the such and such family that has been a dynasty that's lasted over 800 years or something like that in Italy. Through, again, think about all the world wars, think about all the political change, think about all the the religious turmoil that's happened in all those years, and that family has stayed. So he asked this particular lady from that family, "What's your secret? How do you guys maintain wealth?" And she said 3 things: real estate, gold, and art. Precious art. When the hordes are coming to invade, you take the canvases out of the frame and roll them up, and you leave. And you take the gold, you travel with the gold, and then you take the deeds to the property, and then you leave town. And then when things settle down, you come back. Your claim to the property is still valid because, of course, you're the true owner. And then obviously you still have your gold, you still have your art. So yeah, it's a strategy that's interesting to think about again. But the point there is, again, invest in real estate.
Yeah, no, that's a really great story. And I also want to just go back and unpack, really a theme that you had in your whole story as well, right? And it was really all about delayed gratification,
Mhm.
right? And it's tempting to buy that mega house or that next biggest car, all these things that are in front of us all the time. But you were able to actually have the financial discipline, right? Being the CEO of your own personal economy, to do that in a measured way. And I think when you have a wealth strategy and a plan, right, this is not about getting rich overnight, right?
Right.
People kind of think about the lottery or things like some big liquidity event, right? But this is more about creating a disciplined plan over the long term.
Yeah, absolutely. Again, there's, I forget who it is that talks about delayed gratification as a sign of maturity, because again, you have the patience to, they ran tests, and you may have heard of these tests where, you give it to 3-year-olds or whatever it is, hey, do you want one marshmallow now, or do you want 2 marshmallows later, so they leave a marshmallow on the table, and then they watch the kid and see what happens when the adult goes out of the room, and a lot of kids are going to grab that marshmallow, but then there are only a couple that are going to wait because they get 2 marshmallows if the first one's still there. So it is a sign of maturity. And again, I don't say that disrespectfully at all, but at the same point in time, I think it's a factor of education. Had I known then what I know now, I would have started investing much, much earlier than I did. I would have really figured out a way. Yes, I was the busy professional as I talked about, but at the same point in time, I would have figured out a way to really try to take a little bit of time, even if it's 10 minutes a day. Just take a little bit of time and learn about how to do something differently. Learn about perhaps it's investing in gold, perhaps it's investing in real estate, perhaps it's investing in something. Try to personally develop yourself to learn about other means that you can buy, whereby improve your life, improve your family's life, improve your future. And so that huge it's been a huge journey for me to really kind of get on that path to really learn about leveraging the direct delayed gratification in terms of educating myself about how to do things is really important. And I definitely think that it's been well worth it. We certainly are on a really good path now.
Yeah, absolutely. And I think that's also such a great lesson that we can all teach our kids as well, right?
Yeah,
I mean, they're
yeah,
growing up in these days of social media and just everything is flash, flash, flash. They become
right.
really desensitized to everything. But that concept of delayed gratification is really so valuable. If you can instill that in them in an early age,
Yeah.
it will really pay big dividends.
Yeah, and Dave, just to go on a little further, one thing that's also, I think, we've really tried to help our kids learn about, and we actually try to apply that forward is, I mentioned that, delay gratification in terms of, invest now. So, Dave Ramsey says it, invest, live today like no one else, so tomorrow you can live like no one else, meaning that, make sacrifices now so you can have a better life down the road. But we also apply that concept of trying to have a better life down the road by really our giving philosophy, in terms of just really how we try to help others. We try to instill, in our kids, the concept that, listen, there are going to be many people less fortunate than you. My kids went to private school, but at the same point in time, there were still people that were much more fortunate than them, and people that were less fortunate than them. So we try to instill that kind of concept about giving, and and again, we do these other groups to really help educate others, because people were gracious with their time to us, and actually that's why we created our foundation as well.
Yeah, that's great. Do you want to tell us a little bit about your foundation?
Oh yeah, please, absolutely, thank you. So it's a 501(c) nonprofit we created last year, the Park Capital Partners Foundation, and we wanted to take an approach that would give us a way to do some things to accelerate the way, part of how we give back. So what we did was we created this foundation. Bill's and my company, Park Capital Partners, funds the foundation. So all the money that's given to the foundation goes to do its best work to help others. We donate a portion of our profits from our company to the foundation. We personally give to the foundation as well. And then finally, this is the thing we were most excited about, is that when investors invest with us, we actually make a donation to honor that investor to a charity of their choice, and they can pick from a list of 15 different pre-existing charities. So what we curated a list of charities that were known for just really good causes, but at the same point in time having there's always some overhead, but having reasonable overhead, and again, we help investors feel good about that. Just listen, they want to invest to make money, but at the same point in time, why not do some good for the world by investing when they invest with us? So we've got a list of different charities that are on our website that investors can choose from. So yeah, we're super excited about that, and we've had very good reception from our investor community about that as well.
That's outstanding, Richard. Really applaud what you're doing there. I mean, it's a super great model. And again, I love that whole model of, giving back, and also,
Yeah.
your mission of trying to improve the lives, right, of the tenants and the communities, right, that we're investing in, as well as trying to help build wealth, right, for our community as well. So that's
Right.
great. What if everything you thought you knew about investing was wrong? Would you like to create a wealth strategy like the top 1% have, and get exclusive access to top private equity deals that provide downside protection, tax efficiency, predictable cash flow, and have a lucrative upside? Discover how with the Pantheon Advantage, and join our investor club today at pantheoninvest.com. And just tell us a little bit about, Park Capital right now. What are you guys kind of focused on in terms of, asset classes, markets, and positioning?
Absolutely. So we set out an initial goal to buy properties within about a 4-hour drive radius of. Bill lives in Asheville, North Carolina. I live a little west of there in a small town called Maggie Valley. But our point was that we want to be able to get to our properties. We're the asset manager of those properties. Yes, we have a third-party property management that's the day-to-day, but our job is to manage the manager to make sure that things are going well. We have weekly calls with our managers, but we also want to be able to get on site. So we set kind of a 4-hour drive radius. So what that did from Asheville is it puts us being able to. We've owned properties in the past in Atlanta Metro. We own currently in Greenville, South Carolina. We love Charlotte, Raleigh, Durham. We haven't bought in Tennessee, but and Nashville's kind of stretching that 4-hour mark. But we're really kind of trying to see about we have another means to get to some other markets. So we're starting to look at some other markets that are great fundamentals in terms of, the population growth, the job growth. So that's the kind of the drivers that we look for. Those things: population, job, rent, path of progress, landlord friendly in terms of just being able to, have reasonable eviction laws, things like that. So that's kind of where we look. And again, when we buy assets, we're buying existing profitable businesses. An apartment complex is a business. So we're buying existing businesses that are above 90% occupancy, that are making money today. And we improve the operations of that property by doing what we call a value added strategy, adding new things to the complex. We might renovate the units. Perhaps they haven't been renovated in 5-10 years, something like that. We add additional services and things for the residents to improve their quality of life and, make the units nicer. So we're trying to stay in the 90s and younger. Our first property was the 70s, and that was a great experience in the fact that it was our first property. We're proud of that, and the fact that we achieved some great returns for the investors. Happy that we don't have that, because there's some headaches with C properties, and again, no disrespect to that, those folks that either own those or live there, but again, we prefer to stay in the B properties and up. So yeah. Anyway, so we expect that that the folks are going to pay their rent along the way. And in doing so, to answer your question, we talked about the sensitivity analysis, and we do the break-even analysis to understand where things are going from the standpoint of, can we handle a drop in occupancy? It's not likely, because I think everybody's aware there's a significant housing shortage in this country. And even if the economy, goes into recession, and heaven forbid people start losing their jobs, there's still going to be apartment demand. So again, that kind of analysis helps us feel better about the projections that we make to ultimately make sure that we are able to make our investors money through the sensitivity analysis, break even, and all the details that I talked about. So
right. No, that's helpful. And on the break even, where do you typically see apartments? Is around 60-65% before you would actually start to lose money?
So there's kind of two answers to that question, and one answer that I want to point that out, that some folks, when they're doing their analysis, they forget about this. And what I mean by that is that when you're running your renovation, you have you're creating vacancy, but you're also spending a lot of money. So your break even is actually higher at that point. And then when you finish your renovations, that's when your post renovation break even occupancy kind of can drop. Sometimes I don't know if it's going to go down to 60, but it can drop from say below 80 to maybe into 70s, something like that. But again, keep in mind it's gonna be higher when you're running your renovation strategy in the early point, and then only after you complete your renovation. Why would you say? Because guess what? I just renovated, and therefore I'm generating another $250 a month per unit with that renovation, and therefore because I have generated more income, I can afford to have my occupancy drop a little bit lower than during the renovation process, because I have more income coming in from those higher renovated units, and therefore I can still pay my bank note. I can still pay the investors' returns, et cetera, even easier after the renovations are done.
Right, right. And also from a multifamily perspective, I think a lot of people, when they get into real estate, they think about single family rentals, right? Uh, but in my view, I mean, single family actually has a lot of risk, because if you don't have a renter, you go from, you go to 0% occupancy,
Yeah.
right? You only have one chance. But in multifamily, you can go down to potentially 65% before you're actually losing money on an asset, right? So that creates a lot of flexibility. And then you also have a lot of things you can do with the asset as well. So I find it very, risk averse.
And let me elaborate on that point as well. Don't get me wrong. A lot of people have done very, very well with single family, and I applaud them. That's excellent. I find it to be a lot of hard work. And what I mean by that is, as you said, you have one house, the resident moves out, you go from 100% occupancy to 0. You have 10 houses, one resident moves out, you go from 100% occupancy to 90% occupancy. But when we have 100 units, one resident moves out, we just dropped from 95 to 94% occupancy, things like that. So, and the other thing also is quite honestly, contracts are hard enough. So I'd rather do one contract than 100.
Yeah.
So that's a big advantage that we see as well for the apartments. Yeah.
Nice. And Richard, tell us a little bit about asset management. I've seen you guys implement some really awesome things that support your mission as well, from supporting the community, as well as increasing value right in the property, increasing the net operating income. So from an asset management perspective, what are some of the tactics you've employed to increase revenue and value?
Sure. So first of all, we leverage third-party property management. We always have a professional property manager that's part of our properties. Who knows, someday, when we're bigger, that's something that we might consider taking in-house, but that's down the road. We work with the particular company that we manage with now on multiple other properties in the past, and they do a really nice job for us. But the point there is that, again, you've got a full-time person in the leasing office, maybe 2, depending upon the size of the property. You've got a full-time maintenance person on site, maybe 2, depending upon the size of the property, that kind of thing. So there are on the ground team, and our job as asset managers is to manage the manager. So we manage the property manager. In doing so, again, I said our mission again is to protect our investor money, make the money, and then improve the properties. And to that point, improving the properties is how we're able to increase the net operating income. We renovate an old unit that's been sitting there, when I walk into an apartment complex and I see, a really nice B-class apartment complex that's got a really good age, maybe 25, 30 years old, something like that. And it still has Formica countertops. And then I understand the market. Does the market want stone surface? Well, if it does, maybe it makes sense to do that renovation. And therefore, again, I'm improving the value of that unit to the resident, but at the same point in time, I'm increasing the rent, which increases the net operating income. We also look for other ways to increase the net operating income by providing other services to our residents. And what I mean by that are things like valet trash. Sure, it costs a little bit of money for the resident to pay each month, but I'd be happy to put my garbage at the door and let somebody else pick it up. And that isn't just like once a week. That's that's typically, you know, four days a week over the course, including one weekend day, that type of thing. You know, there are different arrangements that you can set, different service levels that, of course, that you can set. You know, but we also look for ways, you know, if just like any house, you know, I forget who talked about this, but there was somebody that said, listen, if you can go into a house and look for a way to add something that wasn't there before, you unlock value. And an example like that might be, well, is there a small room that you can consider a bedroom? You know, maybe you have to build a closet to be called a bedroom, but that would add value to that house. In the case of an apartment building, you know, we sometimes see units that for some reason don't have washer dryer connections in those units. And we look, okay, is it feasible that we might be able to add washer dryer connections? Of course, it's going to cost some money. You know, you've got construction costs, you've got plumbing, electrical, you know, you have to have a drain line to be able to get it connected up, of course, all that good stuff. But that would add a lot of value, because guess what? The person doesn't have to go, you know, they don't have to go from their apartment across the campus to the laundry facility that's on site, or worse, down the street to a laundry facility that's down the street. So that kind of thing can really improve people's quality of life, I guess, in respect, because I guess, you know, again, I'd rather walk 50 feet down the hall or 30 feet down the hall to go do my laundry versus, you know, having to go, you know, somewhere else. In places where that's something it could be added, we might look at doing that, but better is the case where it's already there. And in that case, what we're going to do is we're going to put washer dryers in the units and include it as part of the rent. And therefore, you move into a brand new units that already got a washer and dryer there, and you're ready to go. So we look for places you know, where we can add that kind of value to the residents, and of course, it helps the bottom line as well. So.
Sure. And there was something I saw you guys implement. It was very small, but I just thought the purpose behind it was really fantastic. And that was that small service that you did to help residents build a credit rating. You know, do you want to talk about that a little bit?
Yeah, sure. Absolutely. So there are folks, and again, people may not realize that when you're paying rent, it's not necessarily reported to the credit agencies. So it doesn't necessarily add to and improve your credit history. And again, those of us who are responsible with their credits, you know, you want to have good reporting. Good reporting, okay, obviously good reporting is better than bad reporting. And then good reporting is better than no reporting, of course. So in the case of, you know, it's not like a credit card. It's not like say like your car loan. Those are reported on a regular basis to the credit reporting agencies, but, you know, paying your rent is not. It's typically not reported. So we came through a service that charges a monthly fee to the residents that actually will help improve their credit score by having the monthly reporting. They're you know, this is the person that the person that wants this is the person that's, you know, trying to build their credit because they're trying to buy a house or something like that. They are trying to, you know, help make sure that the credit world sees them as a responsible individual. So they actually will choose to pay for that, because then we, you know, instead of just reporting the bad negative history of somebody who didn't pay their bills, we're reporting the positive history along the way every month to the credit bureaus. That again helps boost that person's score. So again, that's something that a lot of people chose to be part of because they wanted that reporting in a positive, good news way. So
yeah, and additionally, it incentivizes them, right, to pay their rents on time and everything, right? So they actually now have skin in the game. You guys have increased some revenue, and it's a great cause, right? You're improving the lives of the tenants that are in there, and I think that's, you know, that's awesome that we can accomplish everything at the same time.
Yeah,
for sure.
Yeah, we look for ways to, you know, to add value to our residents. We look for ways to add value to our investors. You know, and there are lots of different ways to do that. And again, of course, it's you know, we're running a business. The job of a business is to make profit, of course, but at the same point in time, we want to deliver value along the way, not just make money at the expense of all value. We're going to deliver value to the resident, to the investor. Yes.
Yeah, that's great. Richard, if you could give just one piece of advice to our listeners about accelerating their wealth trajectory, what would it be?
I would say, well, it's kind of two parts. So I'm gonna cheat a little bit. It's going to be educate and take action. You know, you got to learn, you got to be willing to spend some time and to educate yourself as to what's out there. Learn about the possibilities that are there. Learn about those alternative investments like we talked about. Learn about gold. Learn about, you know, investing in real estate. And again, it doesn't mean you have to have 6 figures in the bank to invest in real estate. You can do it in a lot of different ways. And you know, but again, get smart about it. So spend some time. You know, again, there's a Jim Rohn quote. I kind of butcher the quote every time I mention it, but basically it says something to the effect of the level, people will rarely exceed the level of their capability, but except for the level at which they invest in themselves with their education. And I butchered the quote, but the point is that, you know, take some ownership of where you're going, take some ownership of your future, and educate yourself. But then at the same point in time, you got to do something about it. There are a lot of folks that I've met over the years that are professional students, and again, you know, good for them. They love learning. I love learning. I am a lifelong learner. I will always learn, and I do seek opportunities to learn new things all the time. But at the same point in time, you got to do something about it. You can't just book knowledge. You got to do something out there. So again, educate and then take action to move forward. That's definitely the advice I would give.
Right. The old adage, not knowledge is power, but if you have knowledge plus action, that really equals some massive results.
Absolutely. Yep.
Taking action is key.
Yeah.
Excellent, Richard. Thank you so much for coming onto the show. I think folks will really enjoy this. Learned a lot. Appreciate you sharing your expertise. If folks want to learn more about yourself, Park Capital, what's the best place that they can follow you, get in touch with you?
Yeah, absolutely. So parkcapitalpartnersllc.com is our website, parkcapitalpartnersllc.com. I'll go ahead and give you my mobile number as well. That's area code 404-245-9732, 404-245-9732. Love to have a conversation with anybody who's interested in learning about investing. Again, you know, partly why, let me just digress for half a second, Dave. Partly why, you know, my business partner, Bill, and I, we host 2 monthly meetings. You know, we have a podcast of our own that actually we've had you as a guest, Dave. It was a great show. Yeah. And, you know, we do that to give back. You know, a lot of people were gracious with their time when we were getting started to kind of give us some ideas, some nudges, some pushes, some insights. You know, so that's what we want to try to do for others. You know, obviously we welcome people to invest with us, of course, but at the same point in time, you know, we're happy to have conversations for people that are trying to figure it out, trying to get started and to get moving. You know, please check our podcast out as well. It's called The Road Less Traveled Show. So, yeah.
Awesome. Thanks so much for sharing, Richard. Thanks for coming on the show today. Really appreciate it.
Dave, thank you for having me. I certainly appreciate it. And good luck to all your listeners out there. And, you know, thanks again, Dave, for having me on.
You bet.
Absolutely.